So we have this problem of historical problem in the United States of banks failing, individual banks failing, and that leading to sometimes a bank run and then a larger problem of bank panics. We've talked about some of the attempted solutions. We got the lender of last resort. That was the Federal Reserve's responsibility. That didn't work out very well when the Federal Reserve wouldn't lend through the discount window. We talked about how the FDIC was created, and that did turn out to be effective at stopping bank runs and panics. Okay, there are a number of regulations that we talked about, several. Those regulations I mentioned, chartering regulations and so forth, that would, and I sort of grouped those together. I think I talked about 4 different regulations that not only were they regulations that would reduce the number of bank failures, but they would do so by adding to profits of banks. And banks like those kinds of regulations. I'll mention a couple of other kinds of regulations and then we'll go on. One regulation, limitation on bank assets. These are not always something that, I'm sort of grouping. I've already talked about various types of bank regulations, capital requirements and regulation Q and things like that. And those I sort of put as a group because they contribute to bank profits. These are just some more bank regulations that we can't really describe them that way. Here's a couple of examples. No corporate stocks. No junk bonds. We don't want banks taking risky investments with depositor money. Okay. Now, banks sometimes do buy corporate stocks through the trust department where they, like if you come to them and they are managing your money, not your deposit, but just your assets, your net worth, and they are money managers in that sense. They will manage your money and buy stocks if you put that within their charter of what you want them to do. But that is not bankers using depositor funds or insured funds. And so anyway, that's what I'm talking about here is they can't buy corporate stocks. They cannot buy junk bonds. And there are other types of, they can't just go out and start speculating on diamonds or things like this. And so anyway, banks are limited to what they can do. And there are also limits on the size of the loan to any one borrower. They don't want a bank, let's say, we talked about roughly 2/3, 65% or so of total assets are loans. They don't want the bank just making all of the loans to one borrower. Because then if that borrower gets in trouble, then the bank would have lots of loan losses and that would put it out of business. And so what there would be is a limit on how much you can lend to any one borrower. So diversify the risk. So these are things that banks don't necessarily like. These are bank regulations to reduce the likelihood of risk, but not by just contributing to bank profits. Capital requirements would be another example. Yes, sir.
On the limits to loan size to any one borrower, is that like a ratio of?
It'd be a certain percent, yes.
Of the bank size?
Of its assets, yeah. Okay. Capital requirements. If you'll remember, what we had was the bank and the dollars coming in from deposits, sources of funds. And then a second source was borrowing. And then a third source was capital. And then I mentioned, where does this capital come from? Sale of stock. The sale of stock, not investing in stock. Sale of stock, and then retained earnings. Well, part of this capital, and it's coming from retained earnings, where we don't pay out the earnings, there is an account there which is a reserve for loan losses. And so within these capital accounts, what we say to bankers, we don't just say this to bankers, hey, keep an 8% capital asset ratio. Over here are the assets, the uses of funds. But we don't say to bankers just, hey, keep an 8% capital asset ratio. All the dollars flowing into the banks, if all those dollars are, let's say, 65 and what would this be, 25 and 10, then the bank would have $100 in funds or $100 in assets, and you can see that they would have 10% capital to assets. But we don't say to bankers just keep 10% capital assets, because the amount of capital they need to keep as a reserve is partly dependent on what kind of loans do they make over here. Their largest source of or use of funds is loans. What do we say? This is around, I don't know, 60 to 65, some banks 70% of total assets. And so what we say to bankers is the amount of capital you have to hold on to depends on the riskiness of these assets. And so if we found a bank, and let's say every single loan it makes is just the best, I mean really high quality, virtually no risk to a AAA type of borrower, then that bank would be allowed to keep a smaller capital account. And if we had a bank that's making a lot of really risky loans, then we would have a higher requirement that they would have to set aside for losses. Because, that's what this whole risk rating is about, is if there's a borrower that's AAA, we think we're not going to have very many of those that go bad. I mean, maybe none for years. And if we are making loans that are, A-rated loans or BA-rated loans as opposed to AAA, then we're going to have more losses. And so if we have more losses, then we're going to have more capital to deal with those problems. So anyway, what I'm saying to you is that these capital requirements are a type of regulation that have been fine-tuned over the years. Used to be they were not very stringent, and that wasn't enough. And so back in the 1980s, what were they back in the 1980s? Like maybe 6% capital requirement, 6% capital asset ratio, I think back in the 1960s. And then there were a lot of bank failures. And then the regulators said, that's not enough. And then we looked overseas, and in other countries, they were having the same experience. I believe that back in the 1980s, when the U.S. had a 6% capital asset ratio, and I usually use a K to myself to represent that capital asset ratio. But back in the United States in the 1980s, when we had this capital asset ratio of 6%, I think in Japan it was closer to 2%. Now, if you're only keeping a 2% capital asset ratio, only 2% of your assets can go bad before you're wiped out. And so, anyway, what happened was there were a lot of bank failures in the United States and overseas. And so what happened was this, is in 1988, there was something called the Basel Accords. Where's Basel? Anybody know? I said accords. There were two of them, but in 1980 it was the Basel Accord. There was another one in 2004. This is called Basel II. Where's Basel? Switzerland. And so what happened was the central banks, such as the Federal Reserve and the Bank of England and so forth, European Central Bank, the central bankers got together and they talked about this problem. And then what they said is, what we need to do is we need to force our banks to have higher capital asset ratios. And so that's when those started going up, and that's when we got up to this 8% or so range, 8, 9%. Basel II has come back and fine-tuned that further. And there are lots of countries, really all the countries with what you would call a mature financial system belong to this Basel II Accord. And I wrote down a few things, but let's say that you make a AAA rated loan, or a loan to a AAA rated company, then your capital asset ratio would be adequate if it were 5.6%. So on that asset, if you had $1 million asset, a loan to a AAA company, then you could set aside $56,000 and that would be enough. And if all you did is just make loans to AAA rated companies, now of course you're going to have some liquid assets which are equivalent of cash. And you don't need to set aside capital for cash. But if, let's just say, everything on this side of the balance sheet, your assets, were all AAA rated loans, then you could get by with a 5.6% capital asset ratio. If this were BA, the capital asset ratio would be 20%. And so what I'm saying to you is if every loan you made and every security you purchased, bonds, if they were BA rated, then that bank would have to have a 20% capital asset ratio. Now what we're doing in practice is each one of these loans and securities that they purchase over here has got its own capital requirement. And so some of them will have 5.6 and some 20% and some in between. And then what we see overall is a blend of all those. B rated, what do you think that is? You remember where we put the line for investment grade versus junk? Right? We started here and then we went down to where? Does anybody remember? You don't remember? And so as we go that way, and here we're, what, triple A, this is Standard & Poor's, and this is Moody's, and here's triple B, here's double B. Anyway, so I'm giving you the Moody's description here, right? Anyway, suppose it's B, which is here. What's the capital asset ratio required on that loan? 100%. What's that mean? It means if you loan out $1 million, just add $1 million to your capital accounts. So that's kind of saying, you better not be doing that. You're not going to make much profit on those, are you? Okay. And so anyway, and what does that mean? Add that to your capital accounts. That's what I mean is this, is that if somebody comes in and says to the banker, and they've got a B credit score or credit rating, and they come in and say, hey, I want to take out a loan of $1 million. You have to turn to your owners and say, we need $1 million out of you all invested in the bank so I can do this. And gosh, it may be profitable. Just because it's B rated doesn't mean it's going to default. It's going to have a high interest rate. So we say, well, it's going to be a high interest rate. And maybe they'll feel good about that. But the point is if you're going to make a safer loan, then what you do is you just say out of them, I just want a little bit. We'll mainly use other people's money to generate these profits. And so, anyway, you can see this. And like I say, there's all sorts of grades in between here. But that's where we get this number. When I say the capital asset ratio is 10%, I mean that is an average that is derived from all of the different assets over here that the bank's holding. And those cash type assets don't have any capital requirement. Like if you got money sitting at the Federal Reserve, there's no capital requirement on that. And then if you start, let's say, purchasing commercial paper, we talked about secondary reserves, and you purchase commercial paper and stuff like that, really safe, very low capital asset ratio on that. And then we start getting loans and some securities. Bonds were down here in this last category, and some of them may be riskier, higher capital asset ratio. And so then if each one of these has got its own capital requirement, and we hold all the capital we need, then we look and see, that's X amount, and then we could come back and say, well, when we hold that amount of capital, here's our capital asset ratio. And of course, this 10% capital asset ratio would also include if the bank just happens to be holding more capital than it needs to. There's a minimum requirement, which I was talking about there, but the bank could always have 50% capital asset ratio. There's a bank here in Springfield that holds almost no loans on its books. It's actually a statewide bank, and it's got a local office here. But it has almost no loans, and almost the only thing it's holding on to is securities, and they are either securities issued by the U.S. government or by the state. And so that bank has a very low capital asset requirement. Okay, questions about this? These are the types of things then, and we've talked about several now, but these are the types, I guess the 4 the other day, and here are 2 more, 5 and 6, and there are lots of others. I've got a copy of it, I don't know if it's in my office or at home, I've got a copy of a book, and it's about 1.5 to 2 inches thick, and the paper on it is very, very thin. It's thinner than just normal typing paper or anything like that. Kind of that tissue stuff where you can almost see through it. And the title of that book is The Federal Reserve Act with Amendments. And these are the rules and regulations that banks have to follow. And it's printed on both sides of each paper, and it's just hundreds and hundreds and hundreds of papers. The banking industry is heavily regulated. So when I come up here and give you 6 types of bank regulations, this is just a fraction of all the rules and regulations bankers have to follow. And also then, we've really shortened them down by just kind of saying Basel Accord and so forth. There's a lot more to it than just that. Okay. The overall idea is summarized. The overall idea of bank regulations, how we're trying to make our banking industry safe and prevent failures. When the yes, sir.
Did GSE set to that too?
Is pardon me?
Like Fannie Mae, do they also?
Fannie Mae is not a bank, and so it's got its own rules and regulations, but they have nothing to do with these things that we're talking about now. And of course, Fannie Mae is influenced by and has been political considerations. And it was set up by the government and then sort of given a little push, go out there and succeed, but always sort of monitored by government and affected by government rules and regulations. And so to some extent that's a political, it's a political creature and influenced then by whatever the latest trend is in Washington. But no, these rules do not affect Fannie Mae. The overview is that the bank regulators go out and examine banks. There's a whole bunch of rules banks are supposed to follow, and the bank regulators or examiners go out and look at the banks periodically. And what they do, this is an acronym, is at the end they assign a score, a grade, to banks on how they're doing. And it really comes down to how safe are they, how likely are they to default. You remember the issue is we don't want these bank failures to default. We don't want them to default, number one, because they owe money to people. But we don't want them to default because something bigger may happen that may cause this sort of cascading effect all the way across the United States and cause, ultimately, a depression. Okay? And so we've got this heightened concern about bank safety. And so, anyway, the regulators come out, they examine the banks, and then they come back, and this CAMEL score relates to the risks the bank is taking, the risks of it failing. And let's just kind of talk about these very quickly. Capital is what the C represents. Does the bank have enough capital? And the Basel Accords, Basel II, is the one that is sort of the overriding set of rules. But that is the question. The bank regulators, and the bank regulator is a regulatory body. We'll talk more about who that is later. But they send somebody to the bank, and that's the bank examiner. That's an employee. Okay? But anyway, so the bank regulators look at the bank's capital, see if it's holding enough capital. And so one form of risk to the bank is if it doesn't have enough capital, then its assets would lose value. There wouldn't be enough, if there's not enough capital, there's not enough funds to pay off depositors and borrowers and lenders. And so then that's a risk that the bank carries of failure. I'll say C, asset quality. Chiefly, since 2/3 of the assets are loans, we're chiefly looking at, hey, default risk on these loans. Okay? And that default risk is evaluated in different ways. What the bank has, back in the old days, what they'd have is like a little manila folder with your name on it if you were the borrower. Now this is computerized. But whenever the bank makes a loan, they've got a file on that loan. And that file's got all sorts of information in it, like what's the collateral on the loan, right? Are there any restricted covenants on what can be done with this money? There's information in there on is the loan current or the payments coming in. And so and just any other information pertaining to that. And so the point is, and what was the credit score and so forth when the loan was made, the credit rating. And so when the regulators come and say, hey, show us how you're doing, one thing they're interested in is, show us that these loans you've been making are safe. Show us that they are not overdue, that they are not basically defaulted on. And so then we could just start going through and seeing if these loans are current and so forth. And this would be like in an audit, they could find out that, oh, look, here's somebody with a credit score of 500 and you gave them a really low interest rate. Is this some kind of a sweetheart deal? And oh, we don't see good collateral. What's going on here? This is a risky loan. You should be charging more on this. There's a high default risk on it. You should be holding a lot of capital. And so anyway, asset quality. There are some securities the bank's holding. We talked about the secondary reserves, which would be shorter term type securities, liquid securities, but also then there are bonds. And so asset quality is an issue that pertains to that also. How about this one, management? Competence is one issue. And the other one would be basically honesty. Competence and corruption, your two big ones, or competence and honesty. Are these bank managers competent? Do they know what's going on? You know, here's a deal, and maybe you don't think about it much, but bankers would be subject, bankers are trying to run a good business, honest, upright business, and so they're sitting there and they're trying to deal with their customers in a fair way. But there are people out there, at this very moment, they're just sitting around scheming on stuff. It's going, oh, I wonder if I could cheat somebody out of $10 million this way. And so bankers have got to understand, not only like, oh, here's the paperwork that has to be filled out to make a loan, but they also have to understand the trickery that people employ to basically get a loan that they're not going to pay back. And so bankers have to be competent in what they're doing and understand sort of the state of the art in, like ways that they could lose money. Not so they can go out and take risks, but they need to be competent in what kind of risks are they running, maybe unknowingly. And so competence is an issue. And they also need to be competent in how much they're paying their employees and whether they're opening the right number of branch offices and if they are pricing their loans accurately and things like this. So competence is a big deal. And there is a certain small percent of bank managers that are simply not honest. And they are just cheats. And sometimes these bank managers are high up, and sometimes they're not so high up. Like you could be a loan officer and making loans to friends on very favorable terms. And, like here's a loan. I know it's not going to be paid back. Here's the money. I'll loan it to you at 6%. Good luck. Okay? There have been cases in the past where that kind of thing takes place, but then there's a larger conspiracy underway. Like you come in, maybe I'm a loan officer and you're my friend, and you come in and say, oh, I would like to, I usually do that wink thing. Hey, how you doing today? And then, I'd like to take out a loan. Oh, what are you going to do with it? I'm going to build a hotel. Oh, that's a good idea. A lot of winking back and forth. And then I say, well, we have to fill out all this paperwork. And you say, okay. And maybe what we do is we've got some cohorts over here that aren't in the room and doing the winking, but maybe one of the cohorts would be somebody that is appraising property. And maybe there's some piece of property out here and it's worth $100,000. But we pretend it's worth $10 million. And then we go get an appraiser to say, yeah, here's a $10 million piece of property. And so then we say, oh, you know what? I am only going to loan you $8 million on this property because you have to put down $2 million. And you go, okay. So you take that $8 million loan, and then you go out and buy $100,000 worth of property. And there's really not $10 million worth of property or 8 or anything else. But I say, oh, I, the loan officer, I say, this is a good loan. It was a $10 million piece of property. I only loaned $8 million on that. $2 million they had to come up with out of their own pocket, this borrower did. No, not really. And we could be working with somebody over here also that would falsify other kind of information about your business and so forth. And so, anyway, there is sometimes it'd be at the loan officer level, sometimes at a senior level, but there's sometimes people that are just not honest. But most often, they would not be competent. And things would just overwhelm them. They think they're doing a great job, and they are doing a great job until the day somebody comes in and goes, oh, that money we loaned out the other day, well, we lost $25 million and now we're broke. And How could that happen? Totally surprised. Well, that's not dishonesty, that's incompetence. What was the story? I saw this on C-SPAN one time where there was a bank in Oklahoma City, and it was in a shopping mall, and it was a small little bank. You know, people shopping in the mall would go and just like go in this small little area and do business, and so it was kind of a no big deal kind of a bank. And then they made a couple of loans, and this was down in Oklahoma, and so they made a couple of loans to guys that were out drilling for oil, and those guys hit oil, and then they came in to pay off their loan, and the bankers thought, wow, we charge a pretty high interest rate, and that got paid off. That was very successful. And so then they said, you know what we're going to do? More of that. So then they started making more and more of those loans in the, quote, oil patch. And those loans were paying off, and they were charging high interest rates. And then they said, wow, this is a great idea. And then what they did is they started advertising for large CDs. They started putting their advertisement out saying, we're selling large CDs, and everybody else in the country is paying, let's say, 5%, we're paying 6%. And the money just started coming in. And then they just start making more and more loans in an oil patch. And this was at a time when oil prices were high. And man, they are just doing great. And so then after they had done that for a while, a big bank up in Chicago came down to them and said, hey, you guys are really successful. And they said, yeah, we really are. And the big bank up in Chicago says, we wish we could get in on some of that action, but we're up here in Chicago and we don't have an office down here in Oklahoma, Texas, and so forth. And then this bank in Oklahoma City, in the shopping mall, they said, that's okay, because we could help you out. We'll just sell you some loans. This would be like loan participation. We'll just sell you some loans. And then the bank in Chicago said, wow, we'd love to have them. So then, at this point, this bank down in Oklahoma City they don't need to be quite so careful because somebody's going to buy their loans. And so they're just lending that money out and then turning around and selling those loans to some other bank. And that other bank's taking the risk now. It's their money that we are lending after all. We're not actually lending their money. What we're doing is we're lending our own, but then we're getting ours back when we sell the bank or the loan to somebody else. And what's happening, and this is all reported in the Wall Street Journal later on, is like at the end of the year, these guys would calculate, this is in Oklahoma City, they would calculate their profits at the end of the year, and then they would have parties, and they would like drink champagne out of their cowboy boots. And they are just living it up. Life is good. And this just goes on and on and on. And so then this bank in Chicago, it's just buying billions and billions and billions of dollars worth of these loans. And then another bank or two or three, several, start going, wow, where are you guys in Chicago? Where are you coming up with all these loans? And they said, oh, we got a buddy down in Oklahoma City and blah, blah, blah. And so then these other banks are going, well, I wonder if we can get down on the action. And that bank in Chicago says, we'll put in a good word for you. And so then these other banks start buying loans. And so these loans are just kind of going around the United States. Not everywhere, but a select number of banks. And the Chicago bank didn't just tell their buddies where these loans are, but then they offered to stand behind a lot of them. These loans are so good from that Oklahoma City bank, that if you lose, we'll stand behind you. So anyway, these guys down in Oklahoma City are just getting rich, okay? And then what happened was, after you go out and you just drill for oil and you just keep finding it, finally, the places where you can find oil are taken up, And then people start drilling for oil, and then I said the word dry, and then they start hitting dry holes. And also, a second thing that happened was the price of oil went down. It had been high, and then it went down. And so these guys in the oil patch that were drilling for oil, some of them were hitting dry holes, and then the ones that were hitting, they were selling the oil, but they weren't getting as much. So they start telling these guys in Oklahoma City, we're having trouble. And then the guy in Oklahoma City, those bankers, they start telling this guy in Chicago, who started telling his buddies in Washington State and different places, trouble. And so then billions and billions of dollars worth of loans went bad. Now these guys were incompetent. They weren't crooks. They were just incompetent, making too many loans in too small of an area. They were not diversified, okay, and they weren't setting aside enough reserves. And then those guys in Chicago, they were just totally lousy managers. I already told you about them. I told you about the 8th biggest bank in the United States going broke. Well, the 8th biggest bank in the United States went broke for a lot of problems, but one of them is they were letting loan decisions be made by a couple of, yahoos down here in Oklahoma City at a shopping mall that didn't know anything about the oil patch. Okay, and by the way, then these other banks that were friends with the Chicago bank, Continental Illinois was the name of the bank, they were going broke. These are huge bankruptcies. And it cost billions and billions and billions of dollars to tie this up. I told you the one in Chicago was so big that they couldn't actually close the doors. There was nobody that merged with them, and there wasn't enough cash in the FDIC reserve fund to pay out the depositors. So that was the bailout. Then they just took over the management of that bank for several years. Okay? So this is an example of incompetence. There's an example, I'll tell you, in Tennessee around the same time. And in Tennessee, what happened was the governor's brother, it seems to me like, it's not the current governor, but several years back. The governor's brother, it seems to me like, and his family was in the banking business, and they owned like a main bank, but then they owned other banks scattered around the state. And so then what would happen is they were being examined by their regulators, and so then the regulators would come in and start looking at stuff and then say, well, we find a few deficiencies, but overall, okay. And then like next week or something like that, they'd go to, and they're examining banks all around the state, and so then they go to another bank, but in the same chain or in the same group, and they would examine that bank. And then later on, a week or two or a month later, they'd go to another bank that's owned by the same folks. Come to find out, this bank was, this group of banks, they were just, totally corrupt and broke. And what they were doing is they had some assets that were good, loans and things like that, and securities. And so what they do is after the examination, they would just ship them over to another bank. And then the examiners would come in and look at this stuff and go, oh, okay. And then those would get shipped over to another bank, and then they'd go over and examine that one, and that one looked okay. And these guys had just been making loans that weren't being paid back. So, anyway, there's just any number of things that happen. By the way, they found them is they examined all the banks on the same day. And then it was like, uh-oh, got them. And I think they showed up at the CEO's house, and he was loading records into his trunk to try and take them out and burn them or something like this, put them in a landfill, I don't know. But anyway, they caught him at his house. And so sometimes you have the corruption, and other times you just have, like not good bank managers. But these are the types of things. And by the way, the corruption very often happens at lower levels. The top management, they think they're doing a great job, but there's somebody 3 layers down in the organization, and they may be corrupt. So anyway, the examiners are looking at issues like this. The general rule is, and it's just a general rule, but it's a rule that regulators know, when you see a bank that is growing rapidly, and I don't mean to say 8 or 10% a year, but if you see a bank that is, we'll pick a number out, a $2 billion bank this year, and then 3 years later it's a $12 billion bank, then they start going, wow, I wonder if something's wrong there. Just that fast growth is a tip-off. Banking in general, if you just go out here and find a safe bank that's well managed and so forth, it's going to grow 2%, 5%, 6% in a year. And they say, that's pretty good. Our bank's getting a little bigger all the time, our profits are growing, we feel good about ourselves. But when you see a bank that's doubling in size year after year after year, then there's a good sign that what they are doing is this. On this side, they are purchasing funds. They may be borrowing a lot, or they may be raising the interest rate on their CDs. And so a lot of managed liabilities are coming in where they are purchasing funds and they are growing rapidly, and then they're going out and taking a lot of risk on this side of the operation. And so bank examiners and regulators are looking for rapid growing banks, and that is like a bell is going off saying, you better look closely at this one. E. Earnings or profits, right? Earnings, and they look at current earnings, but they're also making a projection about the future. But Most of the capital that banks have come from earnings, from their profits that they don't pay out as dividends, and they keep plowing that back into the bank's operations. And so they want to know if the bank's going to stay profitable. As long as it has some earnings, then what happens is it's not going broke, at least this year. But anyway, they want to know about, is this bank going to continue to be profitable so they can continue growing their capital accounts, okay, and stay in business. Liquidity is the L. The bank's got to be liquid. You've always got to be able to pay your depositors if they ask to withdraw money. You always got to be in a position to make loans, right? And the liquidity, there's never enough at a time of a bank run. And so what you want to do on liquidity is never get to the point where people would question that. You always want to have enough liquidity. So anytime a valid request is made, you can always say yes. What do we have now? S. There's camels. S is sensitivity. Now, I know what you're thinking. I'm a sensitive guy. But that's not what we're talking about here. Sensitivity to changes in asset prices, changes in interest rates. Okay. Changes in interest rates. We talked about interest rate risk. If interest rates go up, the value of bonds and the value of loans is going down. So it could be that the bank's in a good position today, but if interest rates went up 1%, they'd be broke. And so that is what the regulators want to know, is how sensitive are they to a change in interest rates. And we talked about some of those things that bankers do to avoid interest rate risk, is don't hold a lot of long-term loans on your books. You know, sell them off if you make them. That would be an example. Okay? Or take these hedging operations that I mentioned, where you basically are, every time you take a risk, interest rate risk, by making a long-term loan, make some other investment that, if the loan loses value, this other investment gains value, and then they offset each other. And so anyway, and the same thing is true, interest rate sensitivity is also asset sensitivity or asset value sensitivity, because increase in interest rates, decrease in the value of bonds, decrease in the value of loans. And so these are decrease in the value, that's a decrease in the asset value. So how sensitive is the bank's financial situation to a change in interest rates? Okay, and I mentioned another thing, I ran over it here too quickly, but adjustable rate loans or flexible rate loans, where that if interest rates go up, the banker just increases the interest rate on those loans. So anyway, the bank regulators are looking at all of these things, and when they get done, they've got a score, and the score ranges from 1 to 5. And the 1 is the best. That's the highest. And a 5 means imminent failure. Like, could be tomorrow. Okay? And what the regulators basically say is this, you know, if we come in and we've evaluated all this stuff, and if we see a 1 or a 2, we just leave the bank alone. We shake hands with them and say, see you again next time, and leave. And tell them, you're doing a fine job. And if we see 3, 4, or 5, then what we say is, you know, you guys need to work a little bit on this. We're not really satisfied with what we see. And there's a certain amount of negotiation and a certain amount of advice giving. Here's where we see the problems. You need some more capital, or you're holding too many risky loans, you know, or you don't have enough liquidity, or whatever, these types of things that we're talking about here. And so the regulators step in and they'll negotiate something with them, and they say, here's what we expect to see. And the regulators have a lot of power over these banks. They can negotiate, but also they can just issue an order and say, here's what you're going to do, or else. Or else what? Or else, how about this? We'll fine you a big amount of money. Or else, how about this? We'll remove you from office. We'll just tell your regulators, your regulators, we'll tell your shareholders, your board, that you are gone. Or we can remove people from the board. And you're out. And so, what was it? I think it was Bank of America was talking about in maybe the guy who was running Bank of America, I think he was saying back in 2008 that, I don't know if it was the Federal Reserve or the Treasury Department, was basically saying, here's what we want you all to do. This is at a time of this financial crisis. And if you don't do that, then we will remove members of your board. And so it can be done in a friendly way, it can be done in an unfriendly way, but once the regulators decide something's going to happen, it will happen. What we'll talk about next time is the regulators and some other problems with regulation. So long.